The stock market just smashed through to record highs, and today we're uncovering exactly where the smart money is moving so you can capitalize on these strategic buy zones.
I mean, it is genuinely wild to watch because if you look at the underlying mechanics, like the borrowing costs, the energy prices, none of this breakout should mathematically be happening based on traditional financial models.
Yeah, and that tension is exactly what we are tearing apart today. You are going to learn how the S&P 500 and the Nasdaq just set brand new records despite all those headwinds.
Right.
We are unpacking why Apple flashed a major buy signal, even while dealing with severe, crippling chip shortages. We're going to examine the genuinely shocking news about GameStop trying to execute a hostile takeover of eBay.
Which is just crazy.
Totally crazy. And finally, we will break down the golden rule for protecting your portfolio in what analysts are calling a broad power trend. Welcome to our channel where we discuss finance and financial strategies and support long-term financial growth toward financial freedom.
Glad to be here.
Today, we are diving deep into the market report, bullish momentum, and strategic buy zones in record markets by financial analyst Ed Carson.
Yeah, and just so everyone knows, this is the next part of our ongoing market analysis series, so we highly encourage you to check out the previous market deep dives for a better understanding of how we actually got here.
Right, because our mission today is to completely cut through the dense Wall Street jargon, and break down exactly what these massive market movements mean for you.
Exactly. So I think we really need to start with the sheer breadth of this rally, because after a brief pause, the major indices, they didn't just creep up. I mean, they bolted.
Yeah, the numbers are wild.
Right. The Dow Jones advanced 0.55%, the S&P went up 0.9%, and the Nasdaq gained 1.1%.
Which is huge.
It is. But honestly, the most telling data point in this entire report is the Russell 2000. It advanced 0.9% to set a closing best.
Okay, let's unpack this for a second, because for those who might not follow the day-to-day terminology, what exactly are we looking at with these different names? Like, what is an index anyway?
Sure. So an index is basically just a basket of stocks that represents a specific part of the economy. It gives you a quick snapshot of how the broader market is doing. Like the S&P 500 tracks the 500 largest U.S. companies.
Mostly the giant tech names we all know, right?
Exactly. But the Russell 2000, that tracks small cap stocks.
And small cap means what exactly?
It means smaller companies. Well, relatively smaller. They aren't trillion-dollar behemoths like Apple or Microsoft.
Yeah.
They are the regional banks, the smaller industrial manufacturers, biotechs. And the thing is, when the S&P and Nasdaq are hitting records, you expect tech to be doing well.
Right.
But when the Russell 2000 also breaks out, it tells us this is a broad power trend.
Okay, so wait. I am highly skeptical of this whole rising tide narrative.
Why is that?
Well, if everyone on Earth is talking about artificial intelligence, right, and all the hype is concentrated on a handful of massive tech companies, why are incredibly unglamorous sectors rallying? Like, the report notes that industrials, banks, discount retailers, even energy are being pulled up. Is this just a rising tide lifting all boats? Like, are investors just desperately looking for anything that isn't an overpriced software stock?
No, there's a very real, very physical, mechanical link here. And it basically all comes down to a massive capital expenditure arms race.
Okay, an arms race. Explain that.
So the report specifically highlights these companies called hyperscalers.
Hyperscalers?
Yeah. Think of the tech titans like Alphabet, Google's parent company, that run the massive data centers powering the internet. They are projecting incredibly strong capital spending right now.
Yeah.
Because, building the architecture for AI, it requires unimaginable amounts of physical infrastructure.
Oh, right. Because AI isn't just code floating in the cloud.
Exactly. It requires structural steel. It requires industrial-grade liquid cooling systems.
Oh.
It demands massive real estate acquisitions, brand new power grids to handle the ridiculous electricity load, and complex financing to pay for all of it.
So, okay. The tech sector is basically acting as a massive funnel. The billions of dollars Alphabet and the others are spending on AI, they don't just stay in Silicon Valley.
No, they don't.
That capital is literally bleeding out into the real-world economy. So the industrials are getting the steel and concrete contracts. The regional banks are financing the local real estate deals for those data centers.
Precisely. That is what a power trend actually means. When you have a massive technological shift, the first wave of capital hits the innovators, the software guys.
Right.
But the second wave hits the infrastructure providers. A power trend isn't just a brief couple of green days on a stock chart. It's a sustained upward momentum where big institutional money-like pension funds and global asset managers, they're basically forced to aggressively deploy cash across the entire ecosystem because the underlying economic machinery is just humming.
Okay, but I'm looking at the macro data in this report, and the headwinds staring down this economic machinery are brutal.
Oh, they are terrible.
Right. The report shows U.S. crude oil futures jumped 8% to $101.94 a barrel, hitting a midweek high of over $109. And at the exact same time, the 10-year Treasury yield rose to 4.38%.
Yeah, which is traditionally a nightmare scenario.
Let's break that down for the listener. Why do rising oil prices and Treasury yields usually act as a death knell for a stock rally? Let's start with the Treasury yield.
Sure. So the 10-year Treasury yield, it's essentially the baseline interest rate for the entire global economy. When it sits at 4.38%, it sets a massive floor for the cost of borrowing capital.
Meaning everything gets more expensive.
Exactly. Corporate loans get more expensive, mortgages skyrocket, the hurdle rate for any business trying to generate a return goes way up.
Because money isn't cheap anymore.
Right. And furthermore, if massive institutions can just park their billions in U.S. government bonds and get a guaranteed risk-free return of almost 4.5%.
Why would they risk it in the stock market?
Exactly. They have very little incentive to gamble that money on stocks. So capital usually drains out of the market.
And then you throw $109 oil on top of that. I mean, oil is the ultimate input cost. It prices the shipping, the manufacturing, the logistics.
It touches literally everything.
So if borrowing money is super expensive and moving physical goods is super expensive, corporate profit margins usually just get completely obliterated. Yet the report says stocks rallied strongly directly in the face of this.
Right.
And here's where it gets really interesting. Are these massive AI capital spending plans basically acting like a shock absorber for the broader economy right now?
That is the perfect way to phrase it. We're looking at a historical anomaly. The market is engaged in a massive macro tug-of-war. On one side, you have the traditional economic brakes, the high cost of debt and the high cost of energy.
Right.
But on the other side, you have the AI accelerator. These hyperscalers are essentially signaling to Wall Street that their AI spending is not discretionary. It is an existential arms race.
Because if they stop, they die.
Exactly. If Alphabet or Microsoft stop spending, they lose the next decade of tech dominance. So they are pouring money into the ecosystem, regardless of whether oil is at $70 or $110. Right now, the sheer velocity of that technological capital is just overpowering the traditional brakes.
Okay, so if tech is sort of cannibalizing its own short-term efficiency to build out this massive infrastructure, how do we explain the numbers coming out of a company like Apple?
Apple is a fascinating case study here.
Because the report states Apple flashed a major buy signal, rising 3.3% to $280.25 after reporting 22% earnings per share growth.
Right.
But here is the kicker. They achieved this massive beat while dealing with severe, crippling chip constraints that literally limited their iPhone production.
Which is wild.
Wait, Apple literally couldn't make enough iPhones because of chip shortages, but their earnings still grew 22%. How does that math work? It feels completely counterintuitive that you could sell out of your core physical product because of broken supply chain, and yet your bottom line earnings surge by over 20%.
It does feel counterintuitive, but it forces us to really rethink what drives profitability for these mega cap companies. I mean, think about it from the basics. If a traditional manufacturer runs out of parts, what happens?
Their revenue drops to zero and the stock tanks.
Exactly. But Apple's math is nonlinear. When they report a 22% growth in earnings per share despite constrained inventory, it exposes their incredible pricing power.
Oh,
Since they only have a limited supply of chips, what do? They prioritize putting them into their highest margin devices, the Pro models. They aren't making the cheap stuff right now.
They're only selling the Ferraris.
Right. And on top of that, they lean heavily on their services division, the App Store, cloud storage, Apple Music subscriptions. Those revenue streams require absolutely zero physical microchips to sell, yet they carry massive profit margins.
So it's a masterclass in financial resilience. They aren't just selling hardware anymore. They're monetizing the ecosystem.
Exactly.
And that steady resilience is exactly why the stock flashed what the report calls a buy zone.
Yes.
But the report also highlights other companies entering these buy zones. And I'll be honest, the terminology gets incredibly dense here.
It really does.
It mentions Broadcom regaining a $414.61 cut-based buy point. It notes Corning dived 10% on earnings but rebounded strongly, and Viking Holdings recovered to close above its $81.48 buy point. I want to avoid the typical Wall Street technical analysis jargon. What is a buy zone, and what is the actual human psychology driving a cup-based pattern that makes it a strategic place to deploy capital?
Okay, let's break it down as simply as possible. To understand the psychology of the chart, you just have to look at the human emotions behind the trades.
Okay, human emotions.
Yeah, imagine the shape of a teacup on a graph. The left side of that cup shape, that's when a stock hits a peak and then it drops sharply. Think of that drop as a trap. Thousands of retail investors bought at the absolute top right before the drop, and suddenly the stock tanks.
Oh man, the classic bag holders.
Exactly. They are stuck holding the bag, watching their portfolio bleed red, and they are just praying every single day for the stock to climb back up so they can break even and get out.
Right, they don't even care about profit anymore. They are exhausted. They just want their original money back.
Precisely. So that creates the bottom of the cup, right? It's a consolidation period where the stock kind of just moves sideways for a while, taking a pause.
Okay.
But then slowly the fundamental business improves, like with Broadcom securing new AI infrastructure contracts. So the stock price starts creeping back up the right side of the cup.
Making its way back to that original high.
Right. But as it approaches that original peak, the rim of the cup, which for Broadcom was right around that $414 level, what happens? All those trapped buyers from months ago finally hit their break-even point.
And they sell immediately.
Yes. They aggressively sell to escape the trade, and this creates a massive wall of resistance. So a buy point isn't just a magical line drawn on a chart by a computer. It is the exact moment the market finally absorbs every single one of those desperate, exhausted sellers, runs out of resistance, and breaks through the ceiling.
Yeah.
When a stock like Broadcom pushes past that rim, it signals that the psychological overhead supply is totally gone. The dead weight is cleared, and the stock is free to run.
That makes so much more sense. It isn't just a squiggly line pattern. It's a visual representation of supply and demand clearing out the weak hands.
Exactly.
And while we have these incredibly rational, mathematically sound moves happening with Apple and Broadcom, the report throws us an absolute wild card that defies all of this logic.
Oh, this is the craziest part of the whole report.
It really is. GameStop is reportedly preparing a bid to buy the e-commerce giant eBay. Both stocks just completely soared on the news. I mean, we are looking at a dying brick-and-mortar video game retailer attempting a hostile takeover of a legacy Web 1.0 digital auction site.
Yeah.
So what does this all mean? GameStop buying eBay sounds like a financial meme from 2021 coming back to life. Is this legitimate strategic corporate pivoting, or just financial engineering trying to capitalize on stock momentum?
It is almost entirely financial engineering. But it's actually a fascinating look at how corporate acquisitions work in a late cycle market. Let's start from square one. When one company buys another, they usually look for synergies.
Like, how can we combine our operations to save money?
Exactly. But from a traditional business standpoint, the operational synergy between GameStop and eBay is practically zero. You don't merge a physical strip mall retail chain with a global digital peer-to-peer commerce platform to create efficiency.
Right. That makes no sense.
But you have to look at the currency GameStop is using to make this bid. They aren't using fundamental business profits. They are using inflated equity.
Well, because GameStop trades at a massive premium driven by retail momentum and meme stock loyalty.
Yeah.
Not by the actual amount of video games they sell.
Precisely. When your stock price is artificially inflated by momentum, your equity becomes an incredibly powerful, albeit fragile, currency. Management looks at their overvalued stock and realizes, hey, we need to acquire actual stable cash flow before this meme momentum runs out.
Wow. So they target eBay.
Yes, because eBay, despite being an older internet company, generates massive, predictable free cash flow. GameStop is basically attempting to use its highly valued paper to swallow a cash-generating machine.
It's essentially trying to legitimize a meme by buying a real business. And when you contrast that sheer speculative chaos with the other events the report mentions.
Like Berkshire Hathaway.
Right. Berkshire Hathaway is preparing its first earnings report since Warren Buffett stepped down. We've also got critical, high-quality names like Lumentum, AMD, and Rocket Lab slated to report. With all this noise, from Apple's steady climb to GameStop's wild, speculative bids, we arrive at the most crucial question for you, the listener. How do you actually manage your own capital in this environment?
It's the million-dollar question.
Because the report provides a fascinating core strategy for navigating this specific power trend. It suggests stepping on the gas, leading into aggressive growth names, and even explicitly mentions that investors might use margin, depending on their risk tolerance.
Yeah, but we really need to put a massive warning label on that word, margin.
Absolutely. The report follows that up with a huge caveat. Assuming you are heavily invested, your goal is to just prune your laggards and feed your winners. The report explicitly states active investors don't have to be hyperactive all the time. A lot of money is to be found in the sitting.
Yes. Let's dissect the mechanics of that advice, because using margin in a market where the 10-year Treasury is yielding 4.38% is a remarkably aggressive stance.
Explain how margin actually works for a beginner.
Sure. Margin basically means borrowing money from your broker to buy more stock than your actual cash allows. It is leverage. You're juicing your returns.
But leverage is not free.
Far from it. When the baseline Treasury yield is high, your broker is likely charging you 8%, 9%, maybe even 10% interest on that borrowed money.
So you aren't just trying to beat the market. You have to generate massive double-digit returns just to break even on the interest payments for the debt you took out to buy the stock.
Exactly. It's incredibly risky. And if the stock goes down, you don't just lose your initial investment. You lose the borrowed money, you still owe the high interest, and your broker will issue a margin call.
Which means they forcefully sell your stocks.
Yes, they forcefully liquidate your portfolio at a severe loss just to get their money back. The report mentions margin only because a confirmed power trend is mathematically the highest probability environment for aggressive growth.
But it's a tool that can absolutely wipe out a retail investor who lacks discipline.
100%. The far more profound and honestly safer piece of advice is the psychology of sitting.
I love that concept because the urge to overtrade right now must be totally overwhelming for people.
Oh, it's human nature.
Right. You see your portfolio go up 5% a week and your brain tells you to sell it, lock in the profit, and go find the next GameStop or the next Broadcom. We are just hardwired to believe that constant action equals better results.
We equate effort with outcome. In most professions, the harder you work and the more you tinker, the better the result. But in investing, especially in an equity power trend, excessive tinkering destroys wealth.
Oh, so?
Because every time you sell a winner just to jump into a new stock, you are resetting your risk. You're paying taxes on short-term capital gains, and you're interrupting the magic of compounding interest. When the report says pruning laggards and feeding winners, it means brutally cutting the stocks in your portfolio that are breaking down. Just get rid of them. But you have to ignore the temptation to take early profits on the companies that are continuously breaking through those psychological cup-based resistance levels we talked about.
It sounds exactly like tending to a garden. Your job right now is just to pull the weeds, the losing stocks, and water the flowers, your winners. You don't dig up the garden every single day just to see if the seeds are growing. You just have to sit and let it grow.
That is a perfect analogy, because when the macroeconomic tide is shifting this violently overpowering $100 oil and 4% yields, the massive institutions are deploying capital in multi-month waves.
Right. You can't fight that.
You cannot outtrade a pension fund that is rotating $50 billion into industrials, but you can sit alongside them and let their sheer volume drive your equity higher.
Wow. We have covered an incredible spectrum of market mechanics today. We unpacked how this broad market breakout is being fueled by an absolute arms race in AI capital expenditure.
Yep.
A wave of money so powerful it's acting as a massive counterweight to soaring oil prices and high treasury yields. We broke down the nonlinear math of Apple's pricing power despite not having enough microchips. We explored the psychological trapdoors of technical buy zones and the speculative absurdity of GameStop trying to swallow eBay.
It's been a busy week in the markets.
To say the least.
Yeah.
The through line here is undeniable. We are in a historic market environment, and the ultimate strategy is knowing when to aggressively identify high-quality breakouts and when to have the iron discipline to just sit still.
Just sit on your hands.
Exactly. Let the market do the heavy lifting.
It is a remarkable environment. But, as we look toward the future, there is a very subtle, almost contradictory detail buried in today's source material that I want to leave you with.
Oh, what's that?
Well, we spent this entire time discussing how big tech firms are hiking their capital spending by billions to build out the AI ecosystem, right? And that's pushing the stock indices to record highs.
Right, the hyperscaler spending spree.
Exactly. But a sidebar in the report notes that these exact same tech titans are simultaneously announcing major corporate layoffs. They're explicitly touting AI efficiencies to Wall Street to boost their profit margins.
Wait, really? So they are spending billions on machines while actively cutting the human workforce.
Exactly. And it creates a massive macroeconomic paradox. If the very companies leading the overall economy forward are generating their record profits by structurally replacing human employment with artificial intelligence.
What happens to the broader economy?
Right. More importantly, what happens to the everyday consumers who require a steady paycheck to actually buy Apple's iPhones or pay for Broadcom's cloud services or shop on eBay? What happens 5 or 10 years down the line when the efficiency of AI has just completely hollowed out the consumer base?
Man, that is a staggering systemic question to consider as we watch these stock charts climb to new records. It fundamentally asks if the stock market's current success is essentially borrowing against the future health of the actual economy.
Something to think about.
Absolutely. Thank you so much for joining us on this deep dive. Keep paying attention to the mechanics beneath the market. Don't let the headlines dictate your strategy, and always remember to question the narrative.